Welcome to It's the Economy. While US equities have ruled the roost despite occasional bouts of doubts over AI stocks, US 10-year yields have mostly remained above 4% for a better part of the year despite so many rate cuts, partly due to strong data or doubts over the fiscal deficit, especially if the US Supreme Court holds the tariffs illegal. The higher yields have recently strengthened the dollar index as well, the DXY, to nearly 99. The market is still divided over another rate hike from the Fed, and despite strong ISM data, there are doubts over growth everywhere, not just in the US, because of political uncertainty. To get a fix on everything concerning US bonds, Euro bonds, yields, dollar, yen, rupee, I have with me Sonal Desai, Executive Vice President and Chief Investment Officer with Franklin Templeton Fixed Income. Sonal, pleasure having you back in India with us.
Lata, it's so nice to be here with you.
Thank you. Okay, let me start at the beginning. Okay. How many rate cuts so far? And still, the US yields have remained, the 10-year yields have remained above 4%. What's the forecast for the coming year? Do you see it dipping because of Fed cuts?
No. Actually, so the short answer is, I don't think. I think you're exactly right. You nailed it. The Fed has cut so much, all the way from 550 now to 375. And indeed, US 10-year yields have remained stubbornly above 4. They keep trying to break 4, but they don't get there. And I think that this is a combination of a couple of things. Certainly the fiscal issue, and in the last few days for sure, as it becomes more and more likely that the Supreme Court will express some concerns at a bare minimum on the tariffs, and we start seeing that 10-year yields start inching back up. But you know, to me, the curious thing is not that 10-year yields haven't dropped below 4, but more that they're not at 450 or a little bit higher still. And let me explain why. I think that the Fed currently, with its rates at 375 to 4, far from being moderately restrictive, as Jay Powell says, I think actually they are looser than neutral. And if we don't believe that the US economy is going to tumble into a recession, is going to face a serious slowdown, there is no real need to have rates cut more from here.
Okay. But you know, there is an argument that globally growth will slow, partly because of political uncertainty. You don't see that as an argument that, you know, immigration questions, tariff questions, doubts over growth is not a reason for yields to fall?
I think those doubts are very interesting because I think they're sentiment-driven rather than data-driven. So let me first talk about... And data is strong. And the reality is, let's take a step back and talk just about the US for a moment. The US is effectively, from my perspective, a large closed economy. Before you get worried about this, I'm not saying the US doesn't import anything, export anything, but the US is a $30 trillion economy. 70% of 30 trillion is consumption, 21 trillion. 70% of consumption is services, not tariffed. You keep bringing it smaller and smaller and smaller. Finally, you get to imported goods. 50% of those imported goods are actually excluded from tariffs. So in the end, tariffs, you know, even for the US, tariffs in and of themselves were never a reason to create a growth slowdown. And separately, imports deduct from growth. They don't add to growth. Globally, it is a slightly different issue. You know, different countries to varying degrees depend on exporting to the US. But in the US, I am not sure that we have seen a significant growth slowdown. And I'm happy to talk about things like the labor market.
So in your base case is that there are no more Fed cuts and definitely not in December?
So I would say at this point, we have a government shutdown. So, you know, it's always feasible that by the end of this week or next week, you know, BLS reopens, the government reopens, and we find some shockingly weak data. That is not my baseline. Because right now, what I'm guiding myself by are things like the higher frequency private sector labor market reports, the equity market earnings reports, all of which are still pointing to a relatively strong consumer. And therefore, I'm not anticipating drama from the data when it comes. But suppose it comes. Supposing you get that drama, yes, they will cut. But if you don't get that drama, I think it would be quite reckless for the Fed to cut in December. Okay. Do I think the Fed would cut one more time still in this rate cutting cycle? It's possible. It takes you now to 350. And now, to me, you are 50 basis points loose. And that starts becoming interesting because a lot of the tax cuts, the fiscal expansion embodied in the big, beautiful bill, they come in Q1 of next year. Suddenly, people get tax rebates. Firms have an incentive to invest even more because they get immediate depreciation. So I think some very useful things come to which act as tailwinds for the economy.
Okay. Fair enough. So then the reasons for cutting kind of disappear.
Yes.
Let me come to the dollar index, therefore.
Yeah.
Is it headed higher then, or at least it's not weakening?
I think what we saw in the first half of the year, that dramatic collapse of the dollar.
From 106 to 100.
100. And if I think about the more narrow version, which is if I just look at the G3, the yen and the euro and the dollar, and everyone said, oh, the dollar has depreciated so much, it's depreciated so much. I think what is underestimated is how strong the dollar was coming into this year. In real terms, the dollar was at its strongest level since the Plaza Accords of the 1980s. We've gone through several years, US exceptionalism, all this type of stuff, attracting massive capital inflows. And the dollar was so strong. Against the euro, it was at close to parity at one point.
Yes.
Today, we are at 115, 116. That's close to fair value. So I think we got a dramatic depreciation at the start of the year. 3 reasons. China DeepSeek, Germany suddenly issuing a lot of fiscal stimulus, and then the famous Liberation Day tariffs, which really got everyone worried.
Okay, fair enough. So your any range for the DXY?
So I'd say
first
right
half
now,
of next year?
No, I'd say that there will not, I don't see right now extremely strong directionality. Supposing the tariffs are ruled as being illegal, that means, you get larger fiscal deficits. The interesting thing about larger fiscal deficits, you might see a yield sell-off, and that actually attracts some inflows. It starts becoming a little bit more two-sided as to whether you get a little bit more dollar strength or you are somewhat range-bound.
Okay, ranged. Let me come on in that context to the rupee, though I want to speak about the yen as well to you. We have seen the rupee have a bad or a weak, I call it bad, have a weak 2025. Is it about at the bottom?
I hesitate to call at the bottom. For the reality is we don't have the final tariff picture yet for India, and exports are going to have a certain impact. So again, there are some pros, there are some cons. Over here, what you see is in favor of rupee strength, I would say, are weaker oil prices. This certainly helps India. Against the rupee is the fact that we potentially are going to have more issues with our exports to the US. So I hesitate to call it as such.
Basically, it is capital flows.
It's capital
flows. We don't
flows.
have a trade deficit issue to that extent.
It's capital.
Our issue is a capital deficit. I mean, at the moment, capital flow deficit. So let me first discuss your area. Bonds actually saw decent flows. We've had 3 or 4 years of equity outflows, but it was bond inflow. Even 2025 is a net bond inflow. I think I have the number, over 2 billion is a net inflow. You think Indian bonds will be attractive?
I think actually Indian bonds are attractive. I think they are attractive for a couple of different reasons. One thing to keep in mind is we should not understate the importance of the significant fiscal consolidation that has taken place in India over the last several years. And you have that inclusion in indices. You have a variety of different reasons which are all positive, and quite frankly, India is doing enormously well. You can take point factors like Apple moving 50% of its production here. There are any number of reasons to be optimistic.
And inflation is low.
Yes, and inflation is low. So, against that background, I do think that I think that there are many factors playing to the attractiveness of Indian bonds. So I would note that. Against this, there is the fact that we think that as we look over the longer term, we do think that there may be some steepening still to come in terms of where we are. So Indian bonds are attractive. They could become even more attractive. This is one thing I would say. I would put it that way.
The other thing that has in the past upset the apple cart for global treasuries or global yields is the yen. Do you see a rate hike from the BOJ? How is the yen headed? Is there a lot of yen strength that might upset the markets?
So You know, I would have said the yen is... So first, let's talk about fundamentals. From a fundamental perspective, the yen is one of the most undervalued currencies out there. So, so you see this also in the differential between the euro and the yen, because the euro moved to fair value and potentially maybe even a little bit stronger than fair value, we don't know. But the yen clearly is not there yet. And so the yen has the potential to become stronger, but we also have a new prime minister there who actually is thinking along the lines of policies which on balance would not immediately strengthen the yen. So I would say that, yes, the BOJ probably does need to raise rates. You do have an inflation issue in Japan, but it doesn't sound like there will be any rush to that outcome currently. And counterbalancing that is always the question of fiscal.
Okay. Yeah, there is earlier in this year, the yen moves did disturb all the
yes,
markets.
They did. Those, and I agree. Earlier this year, they did, because there was a great deal of sudden belief that Japan was going to normalize and the US was going to fall into a deep recession. Yes. Therefore, US rates rallied. And so the differential between yields in Japan and the US narrowed. And that, I think, is where that came from.
Okay, the bigger question, of course, which every one of our viewers want to know from you is, where do you stand on gold? We saw that 4,000 plus, and ultimately it is a safe haven play.
It is a safe haven play.
So, how do you see that playing? Does US dollar attract because of tariff issues getting settled, or will gold continue to be a pull?
I think gold actually has regained a position which probably in the next few years, I don't see it losing. I don't know that we will continue to see that rapid ratchet up of gold, because on the one hand, we keep talking about political uncertainty. But Lata, actually, in many respects, political uncertainty has not gone up. We are actually seeing resolution in some areas of long-standing issues. If we're talking about the Middle East, for example, we're thinking about oil. Various areas, we're actually seeing a little bit less uncertainty. So it's true that there is the political uncertainty element, but I think the more interesting thing is for the next several years, we're going to see inflation. And so the two things I don't believe about gold are, number one, or that this is somehow a description of the dollar's loss of its supremacy, and therefore people are going to gold. I think to some extent it is a natural reaction to the fact that inflation globally is a little bit higher than it used to be. And there is definitely more policy uncertainty emanating from the US, but that potentially will last for another few years, and then that could reverse. But I'm not sure that gold's attractiveness fully reverses. And I definitely don't think when people talk about dollar supremacy, this is the end of the dollars, I think that is wildly overblown, because every time there was a lot of excitement, for example, showing that gold had achieved the second largest exposure, reserve status in various central bank holdings. And I think here, the more interesting thing to think about is not that gold achieved it, but why the euro didn't. No. And that, I think, pretty much tells you that the dollar does not have a significant competitor in the currency world.
Fair enough. I think that everybody will buy. Everyone who has got anything to do with the global markets. Just a final question. Give us a range for the rupee for the next 6 months.
So, I am going to hesitate to do that, but mainly because I don't do these point estimates. But I do think, let me put it this way, we do think that the RBI probably can cut 25 basis points to 50 basis points already in December. We think in general the outlook for India is actually really quite strong, and despite all the tariff noise. So there may be some depreciation pressure, but I don't anticipate anything as dramatic as what we saw earlier on this year.
Okay, that's plenty of things you have clarified for us. Thank you very much, Sonal Desai, for coming here and joining us in the studio itself.
Thank you so much, Lata. It's a pleasure.
Well, that's it from Sonal Desai of Franklin Templeton. Thanks much for joining us. After a break, time for Chartbusters.